of balance sheet. Okay, just to refresh your memory a little bit, balance sheet, the left-hand side always is asset, right-hand side is liability, equity. We talked about assets in Chapter 8 and 9, liability, short-term liability, long-term liability in Chapter 10 and 11. And now 12 and 13, we're moving on to equity section of balance sheet. Okay, equity is, the definition for equity is net worth of the business. And equity comes from either raising capital from the public, external generated fund, or it comes from retained earnings. Okay, so equity section in general breaks down to two parts. There's external generated fund based on raising capital from issuing stock. Meaning companies will be issuing stock to the public. Once people purchase the stock, there's capital flowing into the business. So that's one method to raise capital. Another method would be basically generating either sales revenue or service revenue based on the target of that company, the purpose of the company. Later on, net income, remember, always closes into retained earnings account. Okay, so service revenue, sales revenue, those are the ways to internally generate revenue and later on flows into retained earnings. That becomes part of the internally generated net worth of the business. Okay, so equity section breaks down to two parts, paid-in capital and also retained earnings. So we're going to talk about some of the transactions that we will need to know in terms of issuing stock. And on Monday, I briefly mentioned that there's two types of stock. Okay, there's common stock and preferred stock. The difference here, usually preferred stock, the face value of preferred stock usually is significantly higher than common stock. Okay? Common stock, oftentimes the face value is set at a very low threshold. Oftentimes it's just $1 or even a couple of cents. Okay, because there's a regulation that if market value of the stock goes below the face value, the company will be prohibited to issue additional stock. So basically the amount of the face value is an arbitrary amount that company would choose, but oftentimes it's at a very low value. So oftentimes $1 or only a few cents. Okay, so for all the problems, you'll be given what the face value is. You don't have to determine this. Now for preferred stock, another difference other than face value is higher than common stock is that they usually have some of the rights over common stock. So today we'll also be talking about one of the rights that you need to know is having the dividends. Dividends portion, a lot of preferred shareholders will be considered first, and then common shareholders' dividends right will be considered. Okay, so preferred, just by the name of it, they have some of the rights like voting rights or liquidation rights. Dividends, the share that they receive oftentimes is higher than what common shareholders receive. Because if the individual investor shareholder purchases preferred share, usually they spend more money on it. For example, if one share of common stock of face value is $1, preferred stock, let's say, is $50. That basically means if I purchase a preferred share, I'm paying $50 to that company. It's more than a common shareholder will possibly pay to the business. Okay, so preferred shareholders, they have some of the rights over common shareholders, and oftentimes the face value is higher than common stock's face value. Now, when companies issue the stock, keep in mind that face value, par value, would be different from issue price. Oftentimes it's different. So this is also very similar to the case when we talk about bonds. Remember, the face value of the bond may not necessarily be the same as the market price, the issue price of the bond. So that is very similar for shares as well. Company would set a face value, but in terms of later on what the price becomes, so that really depends on oftentimes how the business is operating. If they're operating well, they're well known for by the financial statements that they disclose out to the public, people know that this company has a potential and a growing future, that oftentimes the market share gradually along the years will be increasing. Okay, so market price at the time point when each and every shareholder purchases the stock, it may not necessarily be the face value. So if there's a difference, we will account for the differences in these excess accounts. We call it paid-in capital in excess of either common stock or preferred stock. Okay, so we're going to go into a lot of the situations accounting for issuing stock, either issuing common stock, issuing preferred stock. If it's not at the face value, the differences will go into another account. But they have the same direction. We're just trying to separate what part is face value, what part is additional, above face value. Difference between issue price and face value. Okay, so let's take a look at the first case. Let's say we're issuing stock, and now at the beginning, the face value and the issue price coincidentally is the same. Okay, face value of the stock for each and every stock is $1, and we're also issuing the stock at $1. Okay, now let's say the issuance of the stock, the number is 1 million stocks. So after issuing 1 million stocks, corporation, again, the goal for issuing stock is getting capital in. Okay, one way to get capital is by selling your items, by providing services to customers. Another way is by issuing stock for public traded companies. So once they issue this $1 million of stock, if it's at $1, the market price right now is at $1, so they're getting cash $1 million debited. Credit side will increase their equity, common stock. Okay, so this is issuing common stock at the par value. Par value equals to face value. Okay, so par and face refers to the same, basically the minimum amount for the stock. So this is the case that there's no difference between par value and issue price. You just debit cash for whatever the money that you receive and credit common stock. Just to refresh your memory a little bit, equity falls under the right-hand side of the accounting equation. Remember, asset equals liability plus equity. Liability and equity, both of them, the normal balance side is the right-hand side. So you almost will never see common stock be debited because we're raising capital. Okay, for all the cases that you see, oftentimes common stock will be on the credit side because we're increasing capital, collecting cash, and at the same time, while we collect cash, the left-hand side of the equation, asset will increase, right-hand side equity, common stock will increase. Okay, if we move on to the second case, let's say now we're not issuing at the par value, but at a dollar amount above the par value. So again, issue price may be different from face value of the stock. Face value is just an arbitrary amount that company designate to the stock. So oftentimes it's at a very minimum level. Now if, again, the face value of the stock is just $1, but the issue price right now in the market for the company per share is $20, then for each and every share that company issues, there is a difference, $19. Okay, so if you know the difference here, we just need to know then how many shares are we actually issuing out to the public. If we're issuing, again, 1 million shares, the difference is 19, then we separate this part that's above par value to another account, paid in capital in excess of par. So if we post this information to TheAccount, you will have $1 million under common stock still, the same as the first entry because face value is still $1 times 1 million shares. For paid in capital in excess of par, you have $19 million here on the right-hand side. So that will be the difference between face issue price and face value, and again, times the number of shares. So this TheAccount, you'll have right-hand side common stock increase $1 million, right-hand side paid in capital in excess of par increase $19 million. Now the debit side for cash part here is always the market price or the issue price times the number of shares. Okay, the first example is that the market price is the same as par, so it's $1, you're collecting 1 million. Second example, the issue price, market price is $20. You're issuing 1 million shares, for example, then you're getting 20 million. On the right-hand side, we want to separate what part is the face value, what part is the part above face value. So this part that is above, oftentimes is also called issuing common stock at a premium. Okay, premium means the dollar amount above the par value. Now, unlike bonds, for common stock, we would not have a discount. Okay, if the market price goes below $1, basically companies are prohibited to issue additional stock because this is for the protection, basically to protect creditors. Because all these equity, if it's going below the original face value, then later on, perhaps company will not even have enough fund to pay interest to the people that they borrow money from. So we will only see premium cases. There's no discount to this. You pretty much only see either issuing at the face value, that is already the minimum amount, or above the face value. You would not have a discount for common stock. Okay, let's move on to just take a look before we go over other cases, how we would see these transactions being represented on balance sheet. So again, this is important for each and every chapter. When you know what are the new accounts, you have to ask yourself how would it be represented under financial statements. Because remember, eventually all of these will be posted, will be summarized, and then reported in financial statements. Okay, T accounts and journal entries is just the middle part. But that's not the information that eventually outsiders would see for the company. So they will be viewing financial statements. So if we take a look at earlier that example, if we issued 1 million shares, this example here, it tells you that we have issued already 2 million shares. Common stock account would always hold, again, just the par value times the number of shares. So you see there's 2 million there's. But the part that's above face value, we consider it as another account paid in capital in excess of par. So you see 19 million, earlier the transactions that we just did, 19 million is listed in the second account. They're both part of equity. The purpose here, we're just trying to understand whether we have been issuing this stock at the face value or above it. If it's above it, we have a separate account to hold it. Okay, but the idea is the same, it's part of equity. So if we add them up, the total equity right now is $21 million. That's the part that we externally generated from the public. Not based on selling items, not based on providing sales services of any kind, but based on issuing stock. Okay, so $21 million. At the same time, the cash account under, if we look at asset section, cash account, you also have additional $21 million. Now retained earnings is the second part to equity. It's the internally generated part. That's the part based upon if the company is a service type of business, then that's based on service revenue. If the company is a sales type of business, that's based on sales revenue. Later on, we close it to retained earnings account. Okay, so this $9 million is the part based on providing certain type of goods, providing certain type of service. But the upper part, $21 million, is based on issuing stock, externally generated fund. So net worth of the business altogether, including two parts, is $30 million. Now, if we take a look at the common stock category, it tells you $1 par, that's the face value, and then after that it tells you 20 million shares authorized. Now the 20 million shares authorized is the maximum number of shares that company is able to issue to the public. Okay, so that part will be given to you each and every problem. When a company incorporates, the state will grant them the number of shares that they are able to issue, the threshold of it. So that's 20 million shares. And it tells you right now that they've only issued about 1/10 of it, 2 million shares. Okay, so the dollar amount there, 2 million, is based on that 2 million shares. They still have 18 million shares that they could additionally issue to the public. Okay, so you have to understand the differences. Authorized doesn't mean that they've actually issued out. That's just the threshold that the maximum number of shares that they could issue to the public. The number of shares that they actually gave out is 2 million. So meaning that next year they can decide to issue additional 2 million shares. And then the following year they issue additional 2 million shares. Then we determine what is the market price then, figure out if there's premium based on this issuance. Okay, so total paid-in capital is the sum of common stock and paid-in capital in excess of par. That's the $21 million part. And the balance, how we get to this $2 million, is just the number of shares times face value. So always keep in mind common stock, always just hold the face value times the number of shares. Okay, let's take a look at another example here. So this exercise tells you that a common stock here, let's say the face value is $2 per share, and now the company issued 4,000 shares. So you see that there's issuance 4,000 shares, there's also paid-in capital in excess of par 4,000. So if I give you these 3 lines of information and ask you, what would a journal entry look like? Where would you start? What do you debit and credit here? Okay, what is the par value of the stock here? $2, and paid-in capital is $1, meaning the market price for the stock is not sure. Okay, face value is $2. Paid-in capital in excess of par, remember, is the part above face value. So if the company altogether is issuing 4,000 shares, it tells you face value is $2. It tells you the excess part is $1. That basically means the issue price, the market price, is $3 at the time the company issued the stock. That's why they have a premium account, paid-in capital in excess of par, $1. Okay, so if this is what's shown on balance sheet, and I've asked you if we go backwards, what would the journal entry look like? Then the journal entry will look like this. You have common stock 4,000 times $2, the face value, and then you have paid-in capital in excess of par, the part that's above face value, $1, 4,000 times 1. So the cash part, if we want to calculate this, basically is the issue price $3 times 4,000 shares. That's how we get $12,000. Okay, par value is 2. And the excess part is 1. That together tells you the issue price, the market price of the stock is $3 per share. Okay, so this problem, the issue price, if it's just $2 and the face value is also $2, then we don't have this premium account. It would just be $8,000 here, $8,000 cash, if the issue price is $2. If it's any dollar above $2, then the difference is we put it under this account. Okay, now this $8,000 here, there's a name for this dollar amount, face value times the number of shares. Oftentimes in accounting we call it legal capital. So remember earlier I told you that we can't issue with stock below $2. This is because this part is considered legal capital, basically for protection to the creditors. So companies, if the market price goes below that, they cannot issue additional stock. Okay, just keep this in mind. So if you see legal capital, that basically means the face value times the number of shares, or any amount. If the company doesn't have a face value, any amount under common stock is considered legal capital. So you will see this term in the textbook. Okay, that's the part, the minimum part, the amount that the company needs to maintain in order to protect the creditors, to have enough fund to pay back interest to them. Okay, let's move on to other cases. Now we talked about issuance at par, issuance above par value. Some of the companies, sometimes when they issue stock, they're allowed to not set any par value at all. Okay, so this also happens. Nowadays, some of the companies, they do have a par value set for their each and every share that they issue to the public. Some of the state, they give the company the option to choose whether or not they want to set a face value or not. Okay, so for these companies, then whatever is the issue price, whatever is the market price of the stock at the time they issue it, altogether goes into common stock account. Okay, meaning for these companies, with the case that they don't have a face value set while they incorporated the business, then they don't have the paid-in capital in excess account. Okay, so these two accounts, the premium accounts, only exist if company's stock has a face value. So whether or not they do have one, that depends on each and every state's regulation. Okay, so some cases, if the problem tells you the company issues no par stock, that basically makes the case easier because there's no premium to consider. Whatever is the issue price, that's the price that you times the number of shares you collect the cash for. That's also the price that you record common stock for. Okay, so there are two examples here. If January 1st they issue stock at the time the market price is $1 per share, then the journal transaction will look like this. We would debit cash, credit common stock by the number of shares times market price $1. Well, let's say the following day they issue additional $1 million shares, and now market price boosts up to $20, for example. And in this case, when they journalize entry, again, it's just cash and credit common stock, just the dollar amount that they receive, the market price. Okay, because there's nothing to compare against. When we use the paid-in capital, the premium account, we were comparing market price and face value. But for this case, if the company doesn't have a set face value, then there's nothing to compare against. Everything goes into common stock account. Okay, so this is a case for no par value stock, no face value sets in the beginning when a company started. Some of the states allows companies to not set a par value. So in these cases, the legal capital amount, since there's no face value, legal capital would be whatever is the first journal entry, first issuance of stock to the public. If the first one is the first journal entry when the business started, then that $1 million will be the legal capital. Just the initial transaction, initial stock issuance entry. Okay, so we talked about par value stock, no par value stock. For no par value stock under balance sheet, you would only see common stock under paid-in capital account. Again, you won't see those premium accounts. Okay, so just a reminder. You would see common stock or preferred stock, but no excess amount of T accounts listed. Okay, another case here, if there's a company when they issue no par value stock, later on they may also have the option to determine something like par value, but it's not considered the same term. We call it stated value. Okay, but in accounting, basically we treat stated value exactly the same as par value. So this pretty much goes back to the first case again. It's just the terminology is different. Okay, so this relates to corporations law, some of the regulation policies. And in the accounting course, we're just going to take it as given. Okay, so some of the problems, if it tells you the company issued no par value stock, but with a stated value, you can just think of stated value exactly the same as par value. Okay, because what we do with this is if you know the stated value is $1, and if the market price, let's say, is $3, then again, the differences we consider it as a premium. We call it paid-in capital in excess of stated value. So the only difference between this and the first case is that in excess of not par, but stated value for this account. Okay, but the idea is the same. It's just a matter of fact that some of the companies in the beginning when they issue stock, they have no par value stock. Later on, board of directors determines a minimum amount for the stock. Then they call it stated value. Okay, but if for some of the states that they are determined regulated for corporations to set a par value in the beginning, that's considered par. But if they do it later on, that's considered stated value. But in the perspective of accounting, we treat them pretty much the same. Only difference is this term here, in excess of par value or stated value. Okay, so this case here, the issue price of the common stock is $4. So if the stated value of the stock is $1, assuming this is the example here, then the differences between market price $4 and $1, $3 is considered a premium under the premium account, paid-in capital in excess of stated, because the stated is $1. So this $3 is the difference between market price and stated value. So again, also all part of equity, just we want to separate what part is stated value, what part is above it. Any questions so far? Okay, last two cases. Now we talked about par value stock, no par value stock, stated value. Now other than collecting cash, sometimes business transactions, they may be issuing stock in exchange for other type of assets. Okay, so the idea here, everything else is the same except that sometimes we're not just raising capital from the public by cash. Sometimes this could be an exchange transaction that our company issues stock to another business in exchange for a building or land, other type of assets additional to cash alone. So the majority of the examples that you would see for this chapter is issuing stock in exchange for cash alone, raising capital. But sometimes business to business, they can also in exchange for other type of assets, not just cash alone. Okay, so this is an example that if Smart Touch Company receives a building, then exchange common stock for a building that's worth $20 million. By issuing stock, the stock has a par value of $1. And again, we consider the differences between the value of the asset that we are receiving compared to the face value of the stock, which is $1 million. Differences is under the premium account. Okay, so earlier we were considering issue price and the difference between issue price and face value. Here we're just considering building's market value compared against common stock's face value. And again, if there's differences, it's considered a premium in this exchange transaction. Okay, so for these problems, for these exercise problems, you would see the problem states what is the market value for the asset the company is receiving. It could be equipment, machinery that will tell you the market value for the asset. And you just compare that with face value times the number of shares that you're giving to the other company. And there's differences and there's premium under this transaction. If it's coincidentally the same, then you don't have a premium account. Okay, the last case for these stock transactions here, we have also not just common stock, but also preferred stock. Okay, preferred stock, it works almost exactly the same as common stock as well, except that we're just switching common stock account into preferred stock and also considering market price compared against the face value of preferred stock. If there's differences, then it's considered a premium account as well. So this is pretty much, it looks exactly the same as the first case, besides now we're just talking about another type of stock. So common stock, there's also preferred stock. Again, preferred stock has more benefits compared to common stock holders. Preferred shareholders often receives dividends first. Later on we're going to talk about how to account for dividends, how do we calculate those. And also when a company goes out of business, they usually get the liquidation value of assets first, and then common shareholders will be considered second. Okay, so here's an example if we issue preferred stock at the par value, assuming par value is $50. So again, another difference is par value of preferred stock oftentimes is higher than common stock's par value. So let's say we issue 1,000 shares times $50 as the face value, then you're collecting $50,000 of cash issuing preferred stock. So that's the first journal transaction. Assuming market price is $50, you're also issuing the face value of the stock at $50. The second case here, if the market price later on goes above the original face value, if let's say it's $55, then the differences for each and every share of $5 times the number of shares will give you the paid-in capital in excess of par/preferred. Okay, so we usually have two accounts for these premiums. One holds the premium for common stock, one holds the premium for preferred stock. We would separate these two under balance sheets. Okay, so second transaction, issue price compared against face value 50. The difference is $5 times the total number of shares, 1,000 shares. The difference is here again is a premium for issuing this preferred stock. Okay, so now that we talked about different types of stock, again, under balance sheet, the equity section, generally speaking, two main parts. You have paid-in capital, and the second one is retained earnings. And one is externally generated fund, one is internally generated fund. Paid-in capital now not only has common stock, but also if company issues preferred stock, there's also preferred stock. And there's not only just these two accounts. If the company issues at a premium, very likely there's also these two accounts as well, together with preferred and common. So you may have paid-in capital in excess of preferred, paid-in capital in excess of common stock. So the entire paid-in capital section, there will be preferred stock, paid-in capital in excess of preferred, common stock, and also paid-in capital in excess of common. And the second part will be retained earnings. Just one account here. Together, these forms equity section. In Chapter 13, we'll talk about treasury stock, other cases, but so far these are the accounts that we talked about right now. Okay, 4 of them. Okay, now we talked about 5 different cases. Let's do this exercise here. Try to read these 3 cases and see if you can journalize these transactions on. The first one has a par value common stock. Second one, no par value preferred stock. Third case, if we're not just issuing stock for cash, but issuing it for equipment. How do we journalize these 3 cases? Okay, take a minute to think about it and I'll go over it with you. Okay, for the first journal entry, May 19th, is there a premium for this case? Meaning, is the issue price higher than the face value? It is, right? And the issue price here is $9.50 for each share, but the face value tells you for each common stock is $1. So if we want to journalize this transaction, there'll definitely be cash because the company is issuing stock for the purpose of getting cash here. There'll be common stock. There's also paid-in capital in excess of par. Okay, so for this transaction, May 19th, there will be debited. There will be three accounts here: cash, 2,000 shares times the issue price. Credit side, common stock is always the number of shares times face value, if there is one face value. And the excessive par, market price minus face value, $8.50 times the number of shares. Okay, so there's premium $17,000, and there's common stock face value times shares 2,000. If we were to post this to T accounts, right-hand side common stock 2,000, paid-in capital in excess of par $17,000. Okay, now for the second transaction, how many accounts do we have here? We want to journalize it. Okay, what do we debit here? Cash, and we credit preferred stock, and is that all? That's all, right? Because this is a no par value stock, so there's no face value to compare against. We don't have a premium account here. Okay, so any no par stock, no par common stock, no par preferred stock, if they don't give you a stated value either, then whatever it is, the issue price goes into preferred stock account or common stock account. Okay, so you have 5,000 shares issued here. The market price is $3. Since there's no face value to compare against, we don't have a premium account here. So just 5,000 times $3, debit cash, credit preferred stock for $15,000. Okay, now for the last case here, the company received equipment. The market value of the equipment is $78,000. They issued, in terms of receiving this equipment, they issued 3,000 shares that has $1 par value for common stock. So here we're comparing what we're receiving, $78,000, that's the equipment's value, with the face value of the stock, which is $1, times the number of shares, 3,000 shares that we're giving away. So there is a difference between these $2 amounts. So that goes into the premium account, okay, which is $75,000. Okay, so debit side is no longer cash because this problem tells you that we are issuing stock in exchange for equipment, other type of asset, not just cash. Okay, so if we receive equipment, $78,000, common stock is the part of the equity that we're giving away to others, issuing stock. $3,000, so the difference is here, $75,000 is paid in capital in excess of par. So again, if we post this to T account, you have common stock, right-hand side, additional $3,000, paid in capital, additional $75,000. And earlier we had preferred stock at $15,000. So if we total it up, if we want to represent all of these on balance sheet, you'll see preferred stock 15,000, common stock 5,000, paid in capital $92,000. Okay, if we just summarize all three transactions, if we post them to T accounts represented under balance sheet, preferred stock would be just the second transaction, 15,000. Common stock, if we add the third and the first one, we have 5,000 balance. Okay, paid in capital in excess of par, again, add the first and the third, $92,000. Altogether, the paid in capital section, the externally generated fund section would have $112,000, okay? So just an example, if we posted a T account, if we represented under balance sheet, it would look like this. Okay, so if we take a look at just a summary of all what we talked about, the accounts here. Again, on balance sheet, there would be paid in capital section, externally generated fund, retained earnings internally generated based on sales or service revenues. So the upper part here is our focus right now in this chapter. You see preferred stock, the balance $100,000, paid in capital $5,000. That means that's the portion while they issue the stock that's above face value of preferred stock. Okay, that's the second account. Third, you see common stock. Overall, the face value times shares is $2 million. And then paid in capital, again, the premium. The part while the company issue common stock that's above face value, worth $19,000. Okay, now some of the additional information next to preferred stock and common stock tells you in detail what is the face value of the stock, what is the authorized maximum number of shares the company can issue, and what is the number that they actually issued. Okay, so if we start from preferred stock, that's 6% there. Later we'll talk about this. That's the dividend percentage. Okay, 6% here is not an interest rate. It's a dividend percentage here. $50 is the face value of the stock. 2,000 shares is the total number of shares that they could issue overall. 2,000 is the maximum number of shares. And they actually issued 2,000 shares. They already reached the maximum for preferred stock. Okay, for common stock here, it tells you $1 is the par value. They're allowed, the state granted them the number of shares to issue is 20 million shares, and they've only issued 2 million shares up to now. Okay, so the number of authorized shares may not be the same as the number of issued shares. The company can decide whether they want to issue them all at once, or they issue a little bit every single year. So in this case, for common stock, they only issued 1/10 of it, of the authorized shares. Okay, only 2 million's part. And the sequence for listing this, always, if there's preferred stock in the problem, we will list preferred stock first, then common stock, and then retained earnings. Okay, this is just the general sequence, how we list this under balance sheet. We usually don't flip the order of this. Okay, any questions so far? We'll move on to another section. All right, for the next section here, retain earnings. I'm just going to go over this section very quick because we talked about this in Chapter 4. We talked about this again in Chapter 5. So here's because we're reaching equity sections, and this chapter brought up again retain earnings transactions. But really, you already know all these closing entries. And remember, the sequence is we close all the revenues accounts, and then we close expenses accounts, and then we want to determine whether the company has new net income or net loss. And we transfer that information to retained earnings account. So retained earnings really is the account that holds accumulated net income on a yearly basis. Because remember, income statement accounts are temporary accounts. So we usually zero them out. Income statement only shows whatever that is accumulated for that year or that season. Later on, we'll just summarize them all together under retained earnings account. So here's an example, just very simple. If we have sales revenue, $500,000, and we want to close it at year end, we would debit sales revenue. Again, if we want to zero out accounts, we would post it under the opposite section, opposite direction. Okay, so sales revenue, the normal balance is the right side. When we close it out, we would debit this account. Now, as for income summary for when we close expenses, it's the opposite. Right? Expenses, normal balance is the debit side. So when we close expenses, we will be crediting expenses. Again, closing accounts, the purpose is to zero out all the temporary accounts, and we transfer everything temporarily to income summary. So you have income summary T account, right-hand side, transfer to revenues, left-hand side, transfer to expenses. Overall, then you can determine whether or not the company has net income or net loss for that season. So in this case, it's obvious there's $100,000 revenue in excess of expenses. So we have net income $100,000. Okay, first entry, closed sales or service revenue, any type of revenue accounts, or even contra revenue accounts. Okay, second entry, all different types of expenses. Okay, usually we will list them one by one. Right? Here's just an example that we combine them. Usually, because each and every expense, there's a separate T accounts, so we would separate the expenses. You usually have a whole list of cost of goods sold, advertisement expense, operating expenses, so on and so forth. So the third closing entry, basically we want to do something about this and close out the income summary account. Okay, so the third closing entry here, since it's net income, that will increase retained earnings. Third closing entries increases retained earnings. Okay, if you're confused about income summary direction, just think about whether or not net income, whether the company has net income or net loss, and whether that increases or decreases retained earnings. So net income definitely boosts up retained earnings. So if you know retained earnings is on the credit side, then the other side is income summary. So this transaction here immediately closes out income summary, and you see retained earnings under right side of, you see net income represented under retained earnings, the right side. Now, in the case that company doesn't have net income generated in this year, then this entry we will flip it. Okay, if it's net loss, that reduces retained earnings. We'll be debiting retained earnings, crediting income summary. Okay, but this is a case of having net income. Now, there's dividends. We would also close out dividends. Remember, but again, company do not necessarily give away dividends. So if there is that account, oftentimes we would also close dividends. Again, dividends reduces retained earnings. So when we close dividends, that would debit retained earnings, credit dividends. Which one? It's on the debit side because earlier we had net income here, and if we want to close out this, then we will be posting it to this side. Okay? And then also retained earnings increases, so retained earnings definitely is on the credit side. Okay, now just additional information here. If this is the part that we didn't mention in chapter 4 and 5, if a company doesn't have earlier accumulated retained earnings and now they have a net loss, then oftentimes this basically is a negative dollar amount. So this sometimes happens when a company just started. They don't have accumulated net income from the past, and right now their expenses still overweighs their revenue, sales revenue or service revenue. This is what we call deficit balance. Deficit balance just means a negative retained earnings, meaning they don't have retained earnings yet. So far, their expenses outweighs their revenues. So in this case here, if it's deficit balance, on the balance sheet you would see retained earnings having a bracket, because that's basically showing the net loss information. Okay, generally speaking, most of the companies later on will have a positive dollar amount. So when you look at balance sheet under equity section, you will just see a dollar amount listed as retained earnings. But if the company hasn't yet got net income, so far they only have net loss, then what's listed under equity will be a deficit balance of retained earnings. That basically just means a negative dollar amount. So you will see a bracket around retained earnings. That means net loss. Okay, so here's a contra example. Earlier we talked about net income. This is an example of net loss. And when you close the account, income summary will be credited, retained earnings will be reduced, debit, retained earnings account. So on balance sheet, you see a bracket around that number. I'm going to move on to dividends. Now, dividends, again, if company decides to, oftentimes if they do have net income, they have enough retained earnings accumulated, and they reward investors by giving dividends at year end. So when it comes to dividends, there are usually 3 important dates. Companies, the board of directors, they will declare the amount of dividends, declare the amount in total that they're giving away to shareholders, including preferred shareholders, common shareholders. Then usually about 2 weeks later, there will be a date of record. Date of record just means they want to determine from that date, before that date, any shareholders that purchased stock before this middle date here will be receiving the dividends. Okay, and then the third, usually another 2 weeks later, that will be the payment date, so when it reaches year end. Okay, so there will be a declaration date for dividends. There will be a date of record to determine who are the shareholders that receives dividends this year. So meaning after this date, if any other shareholders purchases a stock, they will fall under the following year's bracket. Okay, they will not be receiving dividends until next year. Payment date, the date that shareholders actually receives the dividends. Okay, so cash dividends causes a decrease in both assets and equity. Cash dividends means that shareholders basically are receiving checks. So companies' perspective, they're reducing their cash, and they're also using up their retained earnings to give dividends. Earlier I talked about legal capital briefly. Remember the par value times the number of shares. So if a company's equity section no longer has the excess part, then if they only have the minimum, the legal capital part, they are prohibited. They could not give out additional dividends. Okay, so that's another thing. If company at the end, then well, they issue the stock is only at the face value, they don't have the premium accounts, then they can't issue additional dividends out to shareholders. That's in order to protect creditors, the people that borrow them money. So on declaration dates, the journal entry will look like this. There's really just two entries to this. Even though there are 3 dates that relates to dividends, The first date while the company declares the dividends. They haven't actually gave away the stock, haven't actually gave away the cash dividends, but they just declare it. Then what happens is we will record and reduce the retained earnings, and also dividends payable will be credited. Okay, now on the date of data record, this basically just company decides who are the creditors, the shareholders that gets the dividends, so there's no journal entry to the second date. Third date, when company actually pays out the dividends, then they use as cash at the same time. Okay, so there are really two ways to do dividends. In the first 4 chapters, we talked about giving away dividends, just debit dividends account, credit cash. So this is one way to do it. This is when it comes to the payment date. Instead of having the first journal entry having a dividends payable account, some of the companies, they just do a debit retained earnings. They just do at the end the dividends and credit cash. Okay, but some of the companies in the beginning, they will do directly reduce retained earnings and create a dividends payable liability account. Okay, earlier I talked about this is one way to do it. Other companies, sometimes they do it this way. They have one journal entry in the declaration date and then another journal entry here when it actually comes to payment. So you see this as a dividends payable liability reduction because earlier there was a dividends payable created while the company declares the dividends. Okay, so some companies just do one journal entry when it comes to payment date. This is the third one. Other companies, they may do 2 of them. So there are 2 different cases. In the book, you will see a footnote stating that, in this chapter, in the footnote stating that there's some of the companies that does it this way, some company does 2 transactions. So if it's a 2-transaction way, the first one will be declaring dividends but not giving it out yet. So it's considered a liability that company owes to shareholders. So then when it reaches actually paying it out, it will be reducing the liability. Okay, now earlier I talked about there are different types of shares. So there's preferred shareholders, there's common stock shareholders, and how we determine the dividends is a little different. Okay, so this example here directly tells you that we're declaring 6,000, we're giving away 6,000. Now, some of the problems we need to determine which part goes into preferred shareholders' pocket, which part goes into common shareholders' pocket. So how to determine dividends? Earlier on the equity section, I told you there's a percentage to it. The percentage is not interest rate, but it's a dividend rate. So for preferred shareholders, there's 2 ways to determine it. Usually a company in the beginning, they will set a dividend percentage. So in this example, 8%. That basically means 8% of the face value of the share. So in this example, if the face value for a preferred stock is $100, for example, 8% of dividends rate will be given to you. And if the company altogether issued 2,000 shares, and that basically means preferred shareholders has the right to receive $16,000 of whatever the declaration of the dividend is. Okay, once again, if it's based on percent of par value, then the problem will tell you what is the percentage, the dividends rate. They use the dividend rates times face value, which also will be given to you, and times the total number of shares that company issued out to the public. So meaning that if I own 1 share of preferred stock, which worth face value is $100, and I'm getting $8 as my dividend. If I own 2 shares, I'm getting $16 because it's 8% of the face value that I have. So in company's perspective, they're giving away 8% of the total shares that they issued out to the public. Okay, so this is one way to determine a dividend rate. Another way would be just a flat rate of dollar amount. So meaning for each share, the shareholder is getting $3. So then if I have 1 share, I'm getting $3. I have 2 shares, I'm getting $6. It's not based on percentages of face value, but just a fixed dollar amount. So companies can decide whichever way to do it. This is just a way to calculate what is the fund that shareholders is getting. Okay, now as to common shareholders, oftentimes it's just the second one. Preferred shareholders usually has a dividend rate. Common shareholders usually just a flat dollar amount. Could be $1 to each share that a common shareholder has. Okay, and then for most of the problems, you would see that preferred shareholders will be receiving a lot more than common shareholders. Okay, now another thing for dividing dividends between preferred and common, here's two examples. Okay, it looks very complicated, but really it's very simple to it. So if a company declares, the first example, they declare $5,000 of dividends. Second example, they declare $50,000 of dividends. So these are two cases, 5,000 dividends, 50,000 dividends. So sometimes common shareholders will receive nothing. That's the first case. Okay, or just receive a little bit. So the first case here, $5,000, we first calculate what is the part that preferred shareholders is receiving. So assuming, again, 2,000 shares, preferred shareholders, each share is $50, and let's say the dividend rate is 6%. Now you use 2,000 times 50 times 6%, that will give you $6,000 is the total amount that preferred shareholders can receive. Okay, but in this case, if company is only declaring that they're just giving out $5,000, it's even less than what preferred shareholders, their benefit, the total benefit that they could receive. And altogether, that $5,000 goes to preferred shareholders, and common shareholders gets zero. Okay, so we always calculate what is preferred shareholders' rights. What are the part that what's the part that they should be receiving, which is based on the dividends rate times face value times the number of shares. So in the second case, assuming all the numbers are the same, again, 2,000 shares times 50 times the rate. Preferred shareholders should be getting, again, $6,000. Now in this case, if company is giving $50,000 in total, then $6,000 goes to preferred shareholders, and then the remaining goes to common shareholders, $44,000. Okay, so in terms of calculating which part goes into which shareholders, we always consider preferred shareholders' rights first. That will be the total number of shares that company issued out times face value times dividend rate. So $6,000 is the right that they should receive altogether. But if company only issued $5,000, then that altogether goes to preferred shareholders' pocket, common shareholders gets nothing. If company is able to give out more than $6,000, then that additional part goes into common shareholders. Okay, so this is the first concept that you need to know. Another thing is for preferred shareholders, that difference, you see there's a difference, $1,000 that they didn't get in the first case. If altogether company is giving $5,000, they have the right for $6,000. You can assume, unless you see the problem says the dividends is non-cumulative. Otherwise, you can assume that difference, $1,000 that they missed this season, will be accumulated to next season. Okay, so that basically means dividends for preferred shareholders, anything that they did not receive in this year accumulates to the following year, unless the problem states otherwise. Most of the companies, once they issue out preferred shares, dividends rights for preferred shareholders has to be satisfied. And if it's not this year, it will be next year. So in the first case, they didn't satisfy the whole thing. They only gave out $5,000. Then the dividends for preferred shareholders, they have the right to receive additional $1,000 next year. So when next year companies gave out dividends, let's say $6,000, again, they get them in full, and that $1,000 carries on to the following year until the company is able to give more than $7,000. So the dividends that didn't receive this year accumulates to the following year. They have the right to receive it first, and then common shareholders' rights will be considered. As common stock will be on the credit side because we're increasing capital, collecting cash, at the same time, while we collect cash, the left-hand side of the equation, asset will increase, right-hand side equity, common stock will increase. Okay, if we move on to the second case, let's say now we're not issuing at the par value, but at a dollar amount above the par value. So again, issue price may be different from face value of the stock. Face value is just an arbitrary amount that company designate to the stock. So oftentimes it's at a very minimum level. Now if, again, the face value of the stock is just $1, but the issue price right now in the market for the company per share is $20, then for each and every share that company issues, there is a difference, $19. Okay, so if you know the difference here, we just need to know then how many shares are we actually issuing out to the public. If we're issuing, again, 1 million shares, the difference is 19, then we separate this part that's above par value to another account, paid in capital in excess of par. So if we post this information to T-account, you will have $1 million under common stock still, the same as the first entry because face value is still $1 times 1 million shares. For paid in capital in excess of par, you have $19 million here on the right-hand side. So that will be the difference between face issue price and face value, and again, times the number of shares. So this T account will have right-hand side common stock increase 1 million, right-hand side paid in capital in excess of par increase 19 million. Now the debit side for cash part here is always the market price or the issue price times the number of shares. Okay, the first example is that the market price is the same as par, so it's $1, you're collecting 1 million. Second example, the issue price, market price is the differences in these excess accounts. We call it paid in capital in excess of either common stock or preferred stock. Okay, so we're going to go into a lot of the situations accounting for issuing stock, either issuing common stock, issuing preferred stock. If it's not at the face value, the differences will go into another account. But they have the same direction. We're just trying to separate what part is face value, what part is additional above face value. Difference between issue price and face value. Okay, so let's take a look at the first case. Let's say we're issuing stock and now at the beginning, the face value and the issue price coincidentally is the same. Okay, face value of the stock for each and every stock is $1, and we're also issuing this stock at $1. Okay, now let's say the issuance of the stock, the number is 1 million stocks. So after issuing 1 million stocks, corporation, again, the goal for issuing stock is getting capital in. Okay, one way to get capital is by selling your items, by providing services to customers. Another way is by issuing stock for public traded companies. So once they issue this $1 million of stock, if it's at $1, the market price right now is at $1, so they're getting cash $1 million debited. Credit side will increase their equity, common stock. Okay, so this is issuing common stock at the par value. Par value equals to face value. Okay, so par and face refers to the same, basically the minimum amount for the stock. So this is the case that there's no difference between par value and issue price. You just debit cash for whatever the money that you receive and credit common stock. Just to refresh your memory a little bit, equity falls under the right-hand side of the accounting equation. Remember, asset equals liability plus equity. Liability and equity, both of them, the normal balance side is the right-hand side. So you almost will never see common stock be debited because we're raising capital. Okay, for all the cases that you see oftentimes, a balance sheet. Okay, just to refresh your memory a little bit, balance sheet, the left-hand side always is asset, right-hand side is liability, equity. We talked about assets in Chapter 8 and 9, liability, short-term liability, long-term liability in Chapter 10 and 11. And now 12 and 13, we're moving on to equity section of balance sheet. Okay, equity is, the definition for equity is net worth of the business. And equity comes from either raising capital from the public, external generated fund, or it comes from retained earnings. Okay, so equity section in general breaks down to two parts. There's external generated fund based on raising capital from issuing stock. I mean, companies will be issuing stock to the public. Once people purchase the stock, there's capital flowing into the business. So that's one method to raise capital. Another method would be basically generating either sales revenue or service revenue based on the target of that company, the purpose of the company. Later on, net income, remember, always closes into retained earnings account. Okay, so service revenue, sales revenue, those are the ways to internally generate revenue and later on flows into retained earnings. That becomes part of the internally generated net worth of the business. Okay, so equity section breaks down to two parts, paid-in capital and also retained earnings. So we're going to talk about some of the transactions that we will need to know in terms of issuing stock. And on Monday, I briefly mentioned that there's two types of stock. Okay, there's common stock and preferred stock. The difference here, usually preferred stock, the face value of preferred stock usually is significantly higher than common stock. Okay, common stock, oftentimes the face value is set at a very low threshold. Oftentimes it's just $1 or even a couple of cents. Okay, because there's a regulation that if market value of the stock goes below the face value, company will be prohibited to issue additional stock. So basically the amount of the face value is an arbitrary amount that company will choose, but oftentimes it's at a very low value. So oftentimes $1 or only a few cents. Okay, so for all the problems, you'll be given what the face value is. You don't have to determine this. Now for preferred stock, another difference other than face value is higher than common stock is that they usually have some of the rights over common stock. So today we'll also be talking about one of the rights that you need to know is having the dividends. Dividends portion, a lot of preferred shareholders will be considered first, and then common shareholders' dividends right will be considered. Okay, so preferred, just by the name of it, they have some of the rights like voting rights or liquidation rights. Dividends, the share that they receive oftentimes is higher than what common shareholders receive. Because if an individual investor shareholder purchases preferred share, usually they spend more money on it. For example, if one share of common stock of face value is $1, preferred stock, let's say, is $50. That basically means if I purchase a preferred share, I'm paying $50 to that company. It's more than a common shareholder will possibly pay to the business. Okay, so preferred shareholders, they have some of the rights over common shareholders, and oftentimes the face value is higher than common stock's face value. Now, when companies issue the stock, keep in mind that face value, par value, would be different from issue price. Oftentimes it's different. So this is also very similar to the case when we talk about bonds. Remember, the face value of the bond may not necessarily be the same as the market price, the issue price of the bond. So that is very similar for shares as well. Company would set a face value, but in terms of later on what the price becomes, so that really depends on oftentimes how the business is operating. If they're operating well, they're well known for by the financial statements that they disclose out to the public, people know that this company has a potential and a growing future, that oftentimes the market share gradually along the years will be increasing. Okay, so market price at the time point when each and every shareholder purchases this stock, it may not necessarily be the face value. So if there's a difference, we will account for the $20. You're issuing 1 million shares, for example, then you're getting 20 million. On the right-hand side, we want to separate what part is the face value, what part is the part above face value. So this part that is above, oftentimes is also called issuing common stock at a premium. Okay, premium means a dollar amount above the par value. Now, unlike bonds, for common stock, we would not have a discount. Okay, if the market price goes below $1, basically companies are prohibited to issue additional stock because this is for the protection, basically to protect creditors. Because all these equity, if it's going below the original face value, then later on, perhaps company will not even have enough fund to pay interest to the people that they borrow money from. So we will only see premium cases. There's no discount to this. And you pretty much only see either issuing at the face value, that is already the minimum amount, or above the face value. You would not have a discount for common stock. Okay, let's move on to just take a look before we go over other cases, how we would see these transactions being represented on balance sheet. So again, this is important for each and every chapter. When you know what are the new accounts, you have to ask yourself how would it be represented under financial statements. Because remember, eventually all of these will be posted, will be summarized, and then reported in financial statements. Okay, T accounts and journal entries is just the middle part, but not eventually, that's not the information